Gold is in a very strong uptrend. It has broken out of basically a 12-year consolidation. These mines were built 70 years ago, and now they're all hitting a wall of production, and it's declining and grades are going down. It's really a perfect storm, and I think that's what's driven this M&A frenzy that we've seen.
This is Jay Martin.
Brett, it's great to have you here.
Thanks, Jay. Thanks for having me.
I'm looking forward to chatting with you because I feel like the timing's amazing for my audience to understand Metalla better. Like as we were just saying before we hit record, I feel like Metalla's at a bit of a crescendo moment in the company history. It's been 8 years. We're gonna dive into why I feel that way in a minute. But before we do, I'd love to cover something with you. So Metalla's a royalty company. And there has been a crazy surge of new royalty companies in the last 4 years. Now, if you look at the royalty companies that made it, right? The Francos, the Royals, there's usually like one of two things. Usually there's an anchor asset, a Cisco Gold Royalties, best royalty in the business with the Malartic mine, you could say, right? And they kind of built on top of that. Mm-hmm. And you often see that playbook, and that's what takes an emerging royalty company to an emergent royalty company. Mm-hmm. And then there's a few like you and Sandstorm that just like fought your way up, or at least that's how it looks to me. You know, you just like scrappy and got the deals done and enough time and persistence and you get there. Is that a fair analysis of the royalty sector and how investors should be looking at this surge of like opportunities and companies?
I think so. I mean, there's a number of different ways you can grow a royalty company. You could focus on M&A. You can, do it like we did, which is we, really focused on asset allocation, kind of asset by asset, focusing on really capturing the optionality part of the equation, because we feel like that is something that's very misunderstood. Within the royalty sector. Or you could be lucky enough to obviously spin out of a big company.
Sure.
And a lot of the existing royalty companies have been formed that way. And a lot of the smaller royalty companies usually had some form of a spin out as well.
Yeah.
To a degree on kind of what that critical mass was, that varies across the board. But, there's really different kind of ways to go about it.
Because the pitch has been primarily, we're the better inflation bet, right? Our costs are controlled, unlike a producer or a developer. And so your money is safer with a royalty company that would be elsewhere. And that's true. Like, I think absolutely, of course it is. But parking that, you got to look at everything else inside the business. Mm-hmm. And are there too many junior royalty companies right now? And I only say that, I ask that from the standpoint of, do you expect consolidation? Are there too many horses in the race right now?
Well, I think consolidation is, probably a more natural path today. And I think a lot of that is driven based on a lot of the macros in regards to the junior companies having a reasonable cost of capital, a reasonable equity valuation, and really having the ability to be able to grow. When you look at the valuations of, call it the kind of higher quality type of royalties that are acquired, it's still very competitive.
Yeah.
Now there's a lot of more marginal stuff that's out there. But for the most part, like the focus for a smaller company is to be able to kind of make their way up the food chain, if you will. And in this environment today, it is, I would say, very, very difficult. Without a very material financial backer.
Okay.
And so, back in 2016, it was a lot different when we started Metalla. Capital was very inexpensive.
Yeah.
We had interest
rates. Cheap and getting cheaper.
Yeah, exactly. Yeah. We had interest rates basically down near zero. The debt costs were really low. Equity valuations were high. The Fed was forcing basically everyone into the markets to speculate, mm-hmm. because you were earning basically zero on anything you had in the bank account for quite some time. And so during that period of time, we were incredibly aggressive on going out and acquiring assets. And we always took this asset allocation approach, and the path that we kind of grew our business on was really capitalizing on a part of the market that was, I would say, kind of not well understood. We knew that we needed to give shareholders, exposure to some of the highest quality assets with the biggest operators and the best geology. Okay, that sounds very simple.
Sure.
But how do you do that? When you look at the type of operators that will maintain that type of level of quality, and you look at the checks that they would receive for that, I mean, you're talking hundreds of millions of dollars. The really good ones, they don't even take it.
Right.
So, we had to find a way to kind of bootstrap our way into this type of, exposure to these great operators and assets, and most importantly, the geology. And so we did that, buying royalties in the third-party market, and that was kind of how we grew our business. And, again, it was kind of focused around that. I would say like the third-party market, when I say third-party market, these are royalties that were originated sometime before. They're not, they weren't owned by the mining company or the owner of the property themselves. It was, this third party that maybe it was a prospector or a corporate that sold the asset, retained a royalty. Every time projects change hand, these things are retained. And so, that was kind of our strategy on doing that. And so we thought about that, and we're like, okay, like this is a way not very well understood. I think quite a bit bigger of a market than even the peers appreciated at the time. In 2016, there wasn't a lot of royalty companies. They kind of all came up right after us. It was like kind of us and Mavericks and Triple Flag were like the new companies at that time. And then there was a big wave, as you noted. But when we looked at the kind of the value curve, we really studied this value curve to really understand, like, okay, where were the biggest or the best returns for the majors? Like, what made the majors the majors? And when we looked at that, it wasn't these $500 million, $1 billion deals that were being done at very low internal rate of return type of opportunities or transactions, which gave these big companies a lot of optionality on price, but not as much optionality on growth. And when I say growth, I mean going into an asset where you're buying it at a certain stage, and all of a sudden there's a lot more gold found. Which is obviously, for a royalty company, again, for any viewers that are not familiar with how a royalty works, royalty is a non-dilutive. So, you buy that 1%, it's registered typically on title in most jurisdictions, and it's free carried, meaning like once you purchase that, there's no further capital contribution that's required. And that typically goes into perpetuity as long as the property remains in good standing. Once that project comes in production, then it's top line cash flow right off the top. So when we understood that, and we understood, okay, the best assets are really kind of, it's the Gold Strikes, it's the Detours, it's these types of assets that when you find a royalty on this type of geology, it's the gift that keeps on giving. Because when you look back, even after 20 years, the reserves and the resources are still the same. So, here they go through and they mine out their entire mine life, and then 20 years later, they still have another 20 years left.
Because they continue to grow the resource.
Exactly. Exactly. And so this was always a core focus for us when we're, strategically going out and kind of handpicking these assets all around the world. Again, we focused in good jurisdictions, and we really built this business for the next cycle. Like, we always were kind of a little worried that the cycle would happen a little too soon. And, I don't know, I'm like, do we have enough time to buy enough royalties to get us to critical mass? Like, it was 2016. I'm like, okay, well, it was kind of straight down. It looked like there was a little bit of stabilization.
False start in 2016, it looked like.
And we're like, okay, well, we probably have a couple of years. We don't know. We didn't know we were going to have practically almost 8 years that was a big surprise at the time when we started the company. And so, through that time, again, like we were super aggressive. Capital was very inexpensive. And we built up that portfolio. And we focused again on the minimizing the risk and maximizing the optionality within that kind of subset of very good jurisdiction, high quality operator, and great geology.
Yes.
Yeah.
It's interesting what you said about you could be aggressive in 2016 to maybe 2022 because of the cost of capital, because you can make the assumption that cash is so scarce for these junior companies today that this is your hunting season. It's like they're looking for dough right. They need it right now, and you're available to finance these guys, but it comes at a higher cost than it used to. And so getting in the game in 2016 gave you a massive advantage. I mean, you were lucky to be in at that time, right? Because you had this unique market where resource companies had low valuations and cash was cheap, right? It's like perfect environment. Would you say that? Would you agree with that?
Yeah, I would say it was. I said for a.
I don't want to make it sound easy.
No. For a junior company starting out, yes, it was a good environment because, and look, you could see that because there was a lot of new royalty companies that emerged kind of in the following 3-4 years. Yeah. And a lot of them are gone now. We kind of the pendulum has swung the other direction, and we've seen. A huge burst of royalty companies. Now there's not very many left. Juniors, I think there's probably more consolidation to come, not just within the junior royalty companies, but probably maybe the intermediates or even the majors. Yeah. No idea when that would happen, but when you look at the kind of overall trend of the mining industry, the mining industry they haven't done a very good job over the last decade of really investing in the future, like investing in exploration, investing in new projects. There hasn't been as many good discoveries. Like the grades on most of these projects have come down very, very significantly. A lot of the existing projects that are getting financed today were kind of the ones that were, not tier 1, but kind of tier 2, tier 3, passed up through the other cycles. And so, a function of that is you've seen a lot of M&A because these mining companies have to continue to be able to, or they want to continue to be able to produce a certain amount of ounces. And the way to do that without kind of investing in the future is through M&A because they can keep that production profile. But what it does is it really kind of shrinks the industry at the mining side. And, with the royalty side, it's a little bit different, but we are seeing that because, I think that there still is quite a bit of competition out there.
Okay, so stepping into your business model a little bit, I think it's so important when looking at a royalty company to focus on the pipeline because that is the investment in the future. And when you launched the company, I think your initial goal was 100 royalty agreements, and you just passed that goal, like 102 or something today, around there, right? But more importantly, 6 are producing today. And that's got you at a certain level in valuation and revenue. 3 more coming online in the next year, but then 6 to 8 in the next 3 to 5 years. Is that accurate?
Yeah, that's correct.
Okay, so walk us through that, what that means, what that pipeline and trajectory means for Metalla today versus what you're looking forward to.
Yeah. So when we were building this business again, we focused a lot of our efforts on the development side. Again, that's where we saw, the optionality, kind of the land optionality, if you will, the ability to acquire a royalty across a project that where there is a very significant deposit there, but the operators kind of don't know the full extent of it. Okay. And when the operator is Agnico or Barrick or Teck, they have the capital to continue to advance that project every single year. And as those projects advance towards production, they oftentimes grow quite a bit. Yeah. And so that was a big focus for us because that was where, we saw the ability to kind of capitalize on that growth curve. And that was the majority of the assets that we bought. We did buy some assets that were kind of close to production or in production. Those are the ones that it produced for us today.
Yes.
But it's that growth curve, it's that pipeline that, as you noted, that is going to be.
That's the crescendo that I was referring to.
Yeah.
I feel like there's a tipping point moment coming here.
And I think it is. I think there is right now, because when you look at the past 8 years, when you look at everything that we've bought, and then you look at kind of the setup for the market right now. Okay, well, gold is in a very strong uptrend. It has broken out of, you could call it basically a 12-year consolidation. When it hit the highs back in kind of late 2000, I believe it was 11 or so.
Yeah. May 2011.
And, it hit almost 2000, and it kind of came all the way back up to 2000, and then it was bouncing around 2000 for a while. Now it has broken out. And so when you look at that, when you look at kind of from a business perspective, there's times to be aggressive and there's times to be not aggressive. There's times to be kind of cautious. And the benefit that we have is that we went out and we bought all these assets early enough where we were able to price them at, $1,200, $1,300, $1,400. Most of the assets we bought were priced between $1,200 and $1,800. We've seen these assets materially increase.
$1,800
Gold, yes, that's correct.
Yeah.
Materially increase over the last 5 years. Now they're in production.
Yeah.
And so the setup that we have is, I think, very attractive, because we have a number of assets coming online, every single year, that I think will probably last through the better part of a decade from now. And it starts, as you noted, this quarter. Really, everything is starting in kind of the second half of 2024. We just had Tocantinzinho just started production. This is going to be, it's one of the largest gold mines in Brazil. Great operators. The profile of production on that will be around 200,000 ounces a year. And we have Sierra Madre's La Guitarra royalty that just started up production. They'll probably be at a commercial rate by the end of this year. And then we have Amalgamated Kirkland, which is Agnico Eagle. That will be online through probably the end of this year. That's part of their Kirkland Lake camp. And then going into 2025, we've got the Endeavour royalty, which is a bigger royalty for us. It's a 4% NSR. That's on an asset in Australia. And following that, you've got Cote, you've got 15 Mile Stream, you've got a handful of other ones that
Cote is the IM Gold project.
That's correct.
Yeah.
And so we see this nice stair step. Kind of going out every single year, and we really see the profile of the company changing quite significantly over the next few years. And when you look at from an asset base, and you look at kind of where the company will be, 3-5 years from now, with the advancement of all these assets, you look at that profile, it is more kind of in common or correlated with a mid-tier. And I think that our portfolio from an asset profile perspective, does or kind of will break into that level. And it will do that probably in the next few years.
So how does that stair step change the output? I think right now you're around 3,500 gold equivalent ounces per year. Is that accurate? Is that before Tocantinzinho or after?
Yeah, that for 2024, we put out guidance 2,500 to 3,500.
Okay.
We lost one of the royalties that we had that came off last year was a fixed royalty that we structured kind of for that purpose. And so this year, first half of this year is probably going to be a little bit light as Q1 was a little bit light, but as we get into kind of Q3 and Q4, we're going to start to see that's really the start of it. And so, that guidance includes the partial production of Tocantinzinho for 2024.
Okay.
Yeah.
Got it. Okay. So the big news for you in 2023 was the merger with Nova Royalty, which wasn't just a merger. It was sort of a company pivot, because Metalla Royalties was precious metals, it was gold, right? And now you're gold and copper. with Nova's portfolio. Most of my audience is quite familiar with Nova because I covered that story quite extensively through like 2020, 2021, even 2022, I believe. But walk me through that decision making on your end, as deep as you want to go. It was a big one, right? And changed the company materially and probably alters how you're going to go forward in terms of what acquisitions and transactions you might look for now.
So copper was, originally something, along with all base metals, something that you didn't want to mix with precious. And the reason is because historically, the precious metal royalty companies traded at higher valuations than the base metal or the diversified companies.
Sure. Yeah.
And as you know, like I was a co-founder in Nova Royalty as well, and this was a trend that we've been watching for a very, very long time, and that's what we like to do. We like to find very, very long-term trends that we can build great businesses around, utilizing kind of the key commodity within that trend and using the royalty structure, because they go forever, and you can build really great businesses by doing that. A lot changed between not only in the market on kind of how things were valued and so forth, but also the investor sentiment towards copper. And I think over the last kind of 4 or 5 years, copper has become a very, very strategic metal and kind of much more well understood than before among the institutions and even the governments around the world.
Yeah.
And the thesis has played out very well.
Yeah.
I mean, every single year or two, you've got this new, very significant demand for this metal. You've got a very well documented supply deficit that I have seen a number of different studies, basically starting any time between today and like the end of 2025, early 2026. So here's this window where you've got this well documented, and most of these mines were built back in the 50s and the 60s and the 70s. So these are old, kind of decrepit type mines that are just very tired. And there's going to be kind of a new cycle of, call it new generation copper mines that are 100% going to be needed, because at the same time, you've got this well-documented supply deficit. You've got a very significant demand increase with all these new technologies that are coming out as the world's
100%.
moving.
I mean, you told me, I think part of the inspiration for Nova was when you were landing at LAX, walked down to the parking lot and just saw an ocean of EV chargers. And the EV cars hadn't arrived yet, but the infrastructure was in place. And one of the signals that you saw that directed your decision, I think. Yeah,
and it was crazy to see at that time, because at the time there were not a lot of electric vehicles on the road.
Right.
But what I noticed, there's always been different forms of energy that could work, but the problem has always been like there's not the infrastructure, or there's not the commitment to build out the infrastructure
right.
That you have within oil and gas. And so when I saw that, and you'd see different governments making big moves and in regards to their commitments in subsidizing a lot of this infrastructure and so forth. And so we saw this and we're like, okay, we looked at it and we said, okay, well, there's a bunch of commodities involved here. Which one is one that we can really build a company around for the future? Which one will be one? Because technology is a difficult thing. Like technology changes very, very fast. And that's renewable energy right there. It's an emerging tech. It's going to exactly. Yeah. And so, for building a company for the long term, you always want to focus on kind of what you don't want to be building a company on this commodity and then this commodity is now irrelevant
out of the battery process or something like
which
this.
Happens. We've seen since the whole process. And so we went through all the different metals and we said, okay, like copper is the metal that is going to hold all of this together no matter what. And when we looked at copper from a royalty perspective, and just from a market perspective, it was a difficult thing to get exposure to.
No doubt.
very, very few small copper mines ever work. You can have a really profitable small gold mine, and there's lots of them all around.
Yeah.
But these copper mines, they take 10, 20, 30, I mean, not 10, probably 20, 30 years to go from discovery to production.
And tens of billions of dollars.
And tens of billions of dollars. And so, we mapped out the world of, call it the next generation of copper development assets that we felt had the highest probability of being part of this next generation of copper builds.
Yeah.
And then we found all the royalties that existed on them, and we went out and bought them.
And you went after some big ones.
Yeah.
I mean, Copper World, Taka Taka, Vizcachitas, these are big agreements.
Yeah, they are. These are some of the largest, undeveloped copper deposits on the planet. And when you're building one of these mines for a company, like even the biggest companies in the world, they can build one of these mines maybe every 5 years.
Right.
And there's maybe a dozen companies on the planet that have the wherewithal and the balance sheet to be able to execute that. Now, if you can pick that, you could pick the right ones. The average life of these mega copper mines is usually 75 years.
Right.
So even, and that was what the data that was presented to us, in the early days. And we're like, okay, well, most of these reserves are like 20, 30 years, but when you look at, or even 40 years, but when you look at kind of how long they actually go for, and when you look at the old generation, that it makes perfect sense, because you've got this old generation that was, these mines were built 50, 60, 70 years ago, and now they're all hitting a wall of production, and it's declining, and grades are going down, and it's really a perfect storm. And I think that's what's driven the major multinational mining companies, diversifieds, and precious metal into this M&A frenzy that we've seen.
Right.
And we've seen a very significant amount of M&A that has happened, and also that companies have made failed attempts on getting exposure to this metal.
Yeah.
And it's because they know that they need to secure their supply. And Nova saw this back in 2018 and planned for it, and went out and picked up all these royalties beforehand. Before there was all, no one was really looking at copper royalties at that time.
No.
Like, it was pretty boring.
There's a handful of copycats now, though.
Yeah. And Nova built up a great portfolio of copper royalties. And it wasn't until the last couple of years, driven by Mark Bristow at Barrick and other major mining company CEOs on the gold side, that have really pounded the table on copper, that really brought the gold investors around to not only understanding copper, but wanting copper exposure as part of the mix. And so copper is kind of elevated, I believe, above kind of the rest of the base metals. And it fit very well. Putting these two companies together allowed shareholders to get, the combined shareholder group to get exposure to, call it this critical long-term growth metal that is the key part of, call it the new economy.
Yeah.
But also have kind of a more meaningful part of gold and silver exposure, which obviously plays out on the monetary side of the equation.
So what can you share on the revenue forecast front, Brett? I know gold equivalent ounces, and so pick your price to a degree, but given the state of your pipeline and your near-term pipeline, what can you share in terms of what you're looking forward to, where you're at, and where you might go revenue standpoint?
So, I can talk big picture to what that looks like.
Sure.
And when you look at kind of the 3 to 5 year stair step of assets that, you can have a pretty good idea that these are advancing now, whether they come in this year or next year or the year after, there's always a little bit of movement in regards to the ramp up of new mines. But we feel that what we have bought and paid for today will get us within the next 5 years to about 15,000 gold equivalent ounces of production.
Up from
up from
25 to 35
25 to
today.
35 today.
Yeah.
And over the
5x.
next 10 years, like we think it could be much, much larger than that.
Yeah.
When you look at, just a couple of our assets, like our royalty on Taka, our royalty on Castle Mountain, we think there's a reasonable chance that those can both be in production prior to the end of the decade. I mean, the companies are kind of looking at around 2028, 2029 potential on production. And, just those two, will average around 10,000 gold equivalent ounces. So
Right.
a year annually.
Right, a year.
And for Taka's perspective, I mean, it's going to go for a very, 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 very long time.
Yeah.
So, but it's understanding kind of and positioning the shareholders for this. It's that optionality again that I think understanding that is what really sets Metalla apart from at least the rest of kind of the juniors within our sector. I think the one company that does it extremely well is Franco-Nevada, and they were built on understanding optionality. And it's interesting because it's just they will continue to do deals in the $1 million, $2 million, $5 million range, which is interesting for being one of the biggest royalty companies on the planet. But understanding this type of optionality, going in when we saw the Gosselin deposit being discovered, at the time we knew there were royalties there. And at the time, it was really just kind of, okay, well, this is potential exploration, but there's so much at Côté that this is probably 20 years into the future, and it's probably not going to impact anything today, but it looks interesting. And as Gosselin continued to get better and better results, we looked at it and we're like, okay, like this is going to be big. We don't know how big. It was pre-resource, but that was kind of when we wanted to go out. This is when we like to go out, like, okay, great geology, great jurisdiction, big operator. The other mine right next to it is already being built. It's built today. It's in production. And we were able to go out and secure a 1.35% royalty on that asset.
On Gosselin.
On Gosselin.
Yeah.
And part of Côté covers about kind of around 6 to 10% of the Côté reserves as well. For about $6 million US. That was what we paid for it. Now that was pre-resource when it was in exploration. And since then, there's 7.4 million ounces on that project now. We think it'll grow a lot bigger. Now that Côté's in production and they've got a budget, they'll probably be drilling it. I think it's big enough now to have a high level of kind of confidence that it at some point will be integrated into the Côté mine plan.
Okay.
And when you look at kind of the return profile of that, when you can take something that you bought back in, 3-4 years ago, for $6 million and you can kind of quantify, okay, well, just with the ounces that we have in the ground today, there'll be well over 100 million of undiscounted cash flow coming out of this asset. And, once it comes in production, like the payback may be a year or two, maybe 3, and it'll go for as far as you can see.
Okay.
And so when you see that, and you see that on these different types of assets, like, Taka is another great example of that, where, we bought that at a time where it was not very well understood. It was kind of on the back of a big company's balance sheet, not getting a lot of love, but, we knew that it was a great asset, and we knew that they were, the operator at the time was likely going to probably do something with it. And so we picked up that royalty. We bought that for $9 million a few years back, and on a annualized basis, based on kind of 2020-25 mine plan, we'll probably see kind of 3.5 to 4 million in cash flow in the first full year on that royalty. And so, it takes a lot of patience to go that route from a business model and a business strategy. But as these things start to kick in, the return profiles, when you look back on them, are pretty extraordinary. And so, we're lucky to have really great shareholders that understand what we're doing, understand that this is a long-term strategy, but it's a long-term strategy that gives you the foundation and the ability to continue to scale this business.
Yeah.
And like we started in 2016, there were a lot of other companies that started around that same time or after us. Most of them are gone. And what is the real kind of difference? Every company had different reasons for doing different things, obviously, but when you look at kind of the ones that are now kind of best positioned to make that jump, having that long-term view, not having to have the pressure to go out and try to buy growth today when gold's at 24, going to $2,500 an ounce.
Yeah.
So it allows us to be able to be patient in a market where if you don't have that growth, it's really difficult to be patient.
Yeah.
Yeah.
100%. Okay, so the $1 million question, Brett, is when do you feel Metalla will be ready to start discussing a capital return strategy, the dividend? I know you're not going to want to begin that and then have to claw it back if you're not there yet. So it's a big decision. I think it should be taken really seriously. Is that in the vision? Is that in the future? Are you talking about that in the boardroom?
Yeah, it's something that we talk about quite a bit. And, I think it will be ready in the near term and in the next kind of, 1 to 2 years.
Interesting.
I think that we'll be able to, we want to see a couple quarters of production. We want to see how the ramp ups are going.
Yeah.
We've got a lot of different assets coming online in the next 12 months.
Yes.
So we're going to want to see how those are settling out, how they're, we want to see a few good quarters, running at commercial rates and recoveries and so forth.
Get the affirmation.
But,
yeah.
once we can get comfort from that perspective, we want to build, a business where we can not only start a dividend, but we can raise that dividend every single year for a decade. And that's what I think we have the ability to do. And that is what the goal will be here. I think in the future, and I think we're going to be able to execute on that.
I love that. Look, Brett, this has been super enlightening, and I'm really glad you're able to come in and chat with me today and dive into, where you've come from, where you're at. Honestly, more importantly for me, where you're going in the next year, and 3. And I really appreciate it. And I'd love to do it again, a year down the road, 6 months down the road, and we can check in on these developments again.
Yeah, sounds great. Thanks for having me, Jay.
My pleasure.